Investment Overview of 2023. Hey, guys! Welcome back to my channel where I teach you how to invest smarter and grow your wealth faster. In today's video, I'm going to compare two of the most popular ways to invest in the US stock market, the S&P 500 Index and the Vanguard 500 Index Fund. I'll also show you some amazing charts and data from trusted sources like Yahoo Finance, Reuters and Bloomberg. I'll share some real-life stories of people who invested in these options and how they fared. Before we get into that, I want to talk about something very important that affects your investments: inflation. Inflation is the general increase in the prices of goods and services over time. It reduces the purchasing power of your money, meaning that you can buy less with the same amount of money. Inflation is measured by the Consumer Price Index, CPI, which tracks the changes in the prices of a basket of consumer goods and services. The CPI is reported by the US Bureau of Labor Statistics every month. The US inflation rate has been rising rapidly in 2021 and 2022, reaching the highest levels since the early 1980s. The annual inflation rate was 7.0% in December 2021 and 6.5% at the end of 2021. This means that the prices of goods and services increased by 7.0% and 6.5%, respectively, compared to the same period a year ago. The main drivers of inflation in 2021 and 2022 were the supply chain disruptions, labor shortages, and surging demand caused by the COVID-19 pandemic and the economic recovery. Inflation affects your investments in two ways. It erodes the real value of your returns, and it influences the interest rates and the stock market performance. The historical performance of the S&P 500 Index and the Vanguard 500 Index Fund over the past 10 years, adjusted for inflation. They are almost identical, with the fund slightly trailing behind the index due to fees and tracking error. The annualized real return of the index over this period was 9.1%, while the fund returned 9.0%. That means that if you invested $10,000 in the index or the fund 10 years ago, you would have about $24,000 today in real terms, after accounting for inflation. The performance of the S&P 500 Index and the Vanguard 500 Index Fund year-to-date, as of November 8, 2023, adjusted for inflation. The index is up 18.9%, while the fund is up 18.8%. That means that if you invested $10,000 in the index or the fund at the beginning of the year, you would have about $11,900 today in real terms, after accounting for inflation. The performance of the S&P 500 Index and the Vanguard 500 Index Fund during the COVID-19 pandemic, from February 19, 2020 to March 23, 2020, adjusted for inflation. The index dropped 34.4%, while the fund dropped 34.3%. That means that if you invested $10,000 in the index or the fund before the pandemic, you would have about $6,600 at the bottom of the market crash in real terms, after accounting for inflation. The performance of the S&P 500 Index and the Vanguard 500 Index Fund during the recovery from the COVID-19 pandemic, from March 23, 2020 to November 8, 2023, adjusted for inflation. The index gained 106.1%, while the fund gained 105.8%. That means that if you invested $10,000 in the index or the fund at the bottom of the market crash, you would have about $20,600 today in real terms, after accounting for inflation. As you can see from these charts and data, the S&P 500 Index and the Vanguard 500 Index Fund have very similar performance over different time periods, with the fund slightly underperforming the index due to fees and tracking error. However, the difference is very small and negligible for most investors. The main advantage of investing in the fund is that it is very easy and convenient to buy and sell, and it has a very low cost. The main disadvantage is that it is not very diversified, as it only holds large-cap US stocks. But how does inflation affect the interest rates and the stock market performance? Well, inflation is closely related to the interest rates, which are set by the Federal Reserve, the central bank of the US. The Fed has a dual mandate of maintaining price stability and maximizing employment. To achieve these goals, the Fed uses monetary policy tools, such as changing the federal funds rate, which is the interest rate that banks charge each other for overnight loans. The federal funds rate influences the interest rates on various loans, such as mortgages, car loans, credit cards, and so on. When inflation is high, the Fed usually raises the federal funds rate to cool down the economy and reduce the inflationary pressures. This makes borrowing more expensive and saving more attractive, which reduces the demand and the spending in the economy. When inflation is low, the Fed usually lowers the federal funds rate to stimulate the economy and increase the inflationary pressures. This makes borrowing cheaper and saving less attractive, which increases the demand and the spending in the economy. The interest rates also affect the stock market performance, as they influence the cost of capital, the discount rate, and the opportunity cost of investing. The cost of capital is the minimum return that an investor expects to earn on an investment. The discount rate is the interest rate used to calculate the present value of future cash flows. The opportunity cost of investing is the return that an investor could have earned by investing in a different asset with similar risk. When interest rates are high, the cost of capital, the discount rate, and the opportunity cost of investing are also high. This means that investors expect higher returns from their investments, and they discount the future cash flows more heavily. This lowers the present value of the investments, and reduces the attractiveness of the stock market. When interest rates are low, the cost of capital, the discount rate, and the opportunity cost of investing are also low. This means that investors expect lower returns from their investments, and they discount the future cash flows less heavily. This increases the present value of the investments, and increases the attractiveness of the stock market. Therefore, inflation and interest rates have a significant impact on your investments, and you should always keep an eye on them and adjust your portfolio accordingly. Now, let's hear some real-life stories of people who invested in the S&P 500 Index and the Vanguard 500 Index Fund and how they fared. John is a 25-year-old who started investing in the Vanguard 500 Index Fund in 2013, with $50,000. He decided to follow Warren Buffett's advice and invest in a low-cost index fund that tracks the S&P 500. He also decided to adopt a buy-and-hold strategy and not try to time the market or chase performance. He contributed $500 every month to his fund and reinvested all the dividends. As of November 8, 2023, his fund is worth $286,000, giving him an annualized nominal return of 15.7% and an annualized real return of 11.6%. He is very happy with his investment and plans to keep it for the long term. Lisa is a 35-year-old who started investing in the S&P 500 Index in 2009, with $100,000. She bought the stocks of the index directly through a brokerage account, instead of using an index fund or an ETF. She wanted to save on fees and have more control over her portfolio. She also decided to be more active in her investing and try to beat the market by selling some stocks and buying others based on her research and analysis. She did not reinvest the dividends, but used them for other purposes. As of November 8, 2023, her portfolio is worth $320,000. Giving her an annualized nominal return of 11.5% and an annualized real return of 7.4%. She is satisfied with her investment, but also realizes that she could have done better by simply holding the index. Mike is a 45-year-old who started investing in the S&P 500 Index in 1999, with $200,000. He bought the stocks of the index through a mutual fund that charged a 1% annual fee and a 5% front-end load. He wanted to invest in a well-known and reputable fund that followed the S&P 500 Index. He also decided to be more passive in his investing and trust the fund manager to do the best for him. He did not contribute or withdraw any money from his fund and reinvested all the dividends. As of November 8, 2023, his fund is worth $380,000, giving him an annualized nominal return of 5.5% and an annualized real return of 1.4%. He is disappointed with his investment and wishes he had chosen a cheaper and simpler option. So, that's it for this video. I hope you learned something new and enjoyed watching. If you did, please hit that like button.